TGIF, everybody. Hello, Richard, Jays, Hugo. Everyone doing okay? Make it through the week. All right. One thing that you have to admit is that in the face of war, crude put in a key reversal. Well, not quite a key. It would have to take out this low today. By the end of the day, that's 88.44. So we're about 40 pips away from that happening, but it is a 2-week reversal. We closed under something I talked about earlier in the week, 92. 91.95 was the close 2 weeks ago. So looks like the market's focusing more on getting an Iranian deal done than the fear of Putin, at least for now. They're talking about that his military exercises should be over, coincidentally, the last day of the Olympics, and then we'll see if he really does withdraw. But for right now, that this has been a hard trade to take in the face of it. So oil moving the opposite way of gold. Okay, so the gold breakout is right there. We have Gregor with us in about nine minutes. Oh, hi, Gregor.
Hey, how are you?
I think Blake said come in like 10 after. So maybe Blake wants to get a few words in, and Kane and the rest of the crew. But
Morning,
hey, good morning. So Ryan, still quiet in the currencies.
Yeah, good morning, guys. I figured, I know we wanted to let Gregor talk about the markets a little bit, but I figured K-Man, Ryan, I wanted to make sure those guys hadn't blown away. I know it's like, 100 mile per hour winds over there in the UK. See if they have any thoughts, regarding,
I've lost
what's going to be left after the storm passes. And then, just kind of update you guys on a few things that we're looking at, and then let Gregor run. So,
Ryan was out flying a kite with a pint in his hand.
Yeah. Could you imagine going out there with a kite? I mean, how heavy are the winds right now?
They've been about 70, 75 miles an hour.
Yeah, I know I told you this yesterday. I've been through typhoons in Guam. That was kind of just one of those things when you live out in the middle of the Pacific, that happens. But yeah, I mean, north of 100 miles per hour, I had a car, and my car was moved 3 or 4 car spots, and then on its side, that was only at 120, 130 mile per hour winds. So
yeah,
that gets nasty at those. That's neck breaking stuff.
Yeah, it's been up to 122 in places.
God, that's brutal. What's it? Global warming.
Oh, it's pretty cold out there.
Ice age coming.
Ice age coming. Armageddon. Is that it?
No, just an ice age. Get your parka.
Anyway, well, I just want to check in on you guys and make sure you're all good. But as we turn it over to Gregor here in a few minutes, any thoughts as we wrap up this week? It's been a real choppy week. I was had the trading battle with Brent Donnelly yesterday with the 8cap hosted, and it was we were just talking about how this week has been really just it's kind of gross, two-way price action, but really tight ranges. What do you guys have any final thoughts as we head into the week?
I think that's been about it. We've been up and down, up and down, up and down, but you look at it and we've gone nowhere in the grand scheme of things. I think the market's pretty bored with these Ukraine headlines now. Unless we get something big like an invasion or a proper confirmed pullout. We're not, there's still been headlines about breaking ceasefires and this and that and more shelling, and the market hasn't really done a lot on those headlines. So I think there's definite news fatigue going on here. But as we were saying, we're still in well warm ranges. The triangle still triangle, and that's all we can look at. We'll see what the States bring in today. I don't think we've got much data today. We've got Canadian retail sales for last for 1965 or something, because they're always well behind.
I mean, this is the week with the Canadian. I mean, this is how lame it's been. I mean, there's the dollar cat. I mean, it, you know, I mean, we're obviously in this
don't.
What I mean, like, what do you do here?
Triangles.
I know, more triangles just for you, K-Man.
We need a special indicator, triangle indicator. You can just slap it on.
Yeah, right.
Hey guys, if I may add one thing. Hello, I did make it. If I may add one thing. Yesterday, equity markets were down. You know, S&P was down 1.5%, 2%. Cryptos were crashing. Bitcoin was down 6%. Now we're up, and Bitcoin is down again a little bit, but it's not.
Don't you talk smack about Bitcoin?
I know. I saw
just because you like precious metals and all that crap doesn't mean that Bitcoin's irrelevant in our world.
I just want to say there is not theoretical. There is confluence of supports for sure, but this price action makes me a little bit nervous. That's all.
You're trading with equities.
I don't disagree. What?
Sure, trading with equities, risk off. It seems to go down on risk off.
Yeah, you know,
it's not a fear hedge.
Part of the trading battle that we did last night with 8cap is they were one of the, since it's like it was late at night or it was later in the day, one of the battle, like one of the challenges was throw out a trade to your opponent, and I gave Brent the dollar ruble because of current environment. He dumped long Ethereum in my lap and said trade out of it, and I had to mark up this inverted head and shoulder pattern, so it was fine. But I wanted to say that, man, if we get much below 2,800 in Ethereum, it's going to be ugly. And you're right, still we've had a bounce back in equities. Cryptos have not performed at all. So and it's something that if they give up their some of these levels over the weekend, we could see another swoosh down in risk. But I have to say that stocks are near the lower end of their range. I guess this is the chart to pull up here. Here's the S&P. We've talked a lot about this. This head and shoulder pattern developing. Look, if this does develop, and let's just say, I'm right in the guesstimation here, we might have like literally a couple more months of sideways price action bouncing around between 4,200 and 4,700. If in the event that I'm right, that doesn't necessarily mean I'm going to be right, but we're going to be, it looks like we are in a nice range at the moment. Call it nice range. I don't know if I really want to call it nice range. Anyway, couple minutes. K-Man, you have any final thoughts going into the end of the week?
Not really. We have OPEX day today, so there might be a little bit going on in the stocks. Apart from that, I still think the end of the Olympics might be a risk event, regardless meetings being put up between Blinken and Putin or whoever, or Lavrov. Yeah. I still think the end of the Olympics may be a risk event if China starts to fly over Taiwan again or so, and then the Russians might think they have a green light to do something else. So the weekend will still be a risk. So today, for me, it's more like managing the risk and get ready for what can come our way next week.
All right. Yeah. And Jace, swoosh is a technical term. Yes. So is all right. So
one thing. Keep an eye on Aussie Kiwi today.
Why?
There's a large expiry, 2.2 billion going off. And the reason I'm highlighted it today is because when I did the options report that I do every Sunday, sort of the week ahead, which obviously the guys and girls in the chat room can see on the platform.
Yeah.
There was only 894 million last Sunday. So if you scroll that down a bit, Blake, go to where I post up Mondays. Keep going.
You trade these, Ryan, through your FX broker, these FX options?
I don't. That's it, Blake. Just up a bit to that. Keep going. One more. That text there, so you can see there the others of note. So that Aussie Kiwi 894 due today. That's up to 2.2 billion. So that means there's been around 1.4 billion traded this week alone, and that's something that sticks out because a lot of the time some of these options are some of it's set months ago, but because there's been a lot of activity in this week, it might mean that there's going to be something going on. And if you go to an hourly chart or something on Aussie Kiwi, you can see that 1750 has been a bit of a line for the last few days or so. And with the Aussie looking bid, pretty bullish around the other pairs, we might just be waiting for this expiry to pass before we maybe have a little look higher. So it's just something to keep an eye on. Something may happen.
So the put riders might be under pressure is kind of what you're getting to.
They are. I forgot what they are now.
More puts.
Let me have a quick check. I know what they are.
And where can I trade this stuff?
Well, I don't trade it a lot because there's not that very many retail outlets that do decent options at decent prices. K-Man does a bit more than I can. I can do a couple of pairs. But what I mainly look for is how it's going to possibly affect
I'm sorry. Everybody's like, hey, the stocks are coming down. The separatist leader in eastern Ukraine announced evacuation of residents to Russia. So that just came out. And that's, again, headline risk. We are in a headline risk market. That's what's happening. Okay. Sorry about that, Ryan, but continue on.
No, you're right. No, that was it, basically. I look at the options mainly to see if there's going to be any effects in the spot price, if there's any little opportunities, anything kicked out of sync, and this might be one of them.
And that's crazy that it's increased up to 2 billion. So this is just one of the many things as a ForexAnalytix subscriber you have access to. And one of them being obviously the order board and the options, what's happening in the options market. And then one of the other things is we actually have a private webinar in about 60 minutes from right now as we build out the bias chart every single day. So I'm going to pass it over to you, Dale and Gregor, because I know Greg has got a few things he wants to say to you guys, and you guys can get a nice little Elliott wave look at the market. And I want to say, hey, guys and gals, thank you so much for all the support this week. It's been great having you here. And, just remember, we're here every day for free for you. So we'll see you later. K-Man.
Are we
Ryan,
open Monday
Stellis.
with markets closed?
We have President's Day. I don't know. I mean, it's President's Day in the U.S., but I don't know. You guys in Greece, are you guys celebrating our presidents here?
Of course. They're glad they're not.
Yeah, of course you are. How about you, Ryan?
That's a celebration. They're glad they're not theirs.
Our president. You guys going to celebrate Biden? Are you sure?
Celebrating Putin.
What president are we celebrating?
Them all.
Ronnie Reagan, man.
Yeah, Reagan. Roosevelt. Whoever you want to. Really, just whoever. Just celebrate. No, I mean, it's President's Day in the U.S. The volume's going to be a little lighter. I haven't really made a decision. I think we do.
I'll be here.
Yeah, I mean, we'll probably be broadcasting.
What the
hell? It might be slow.
Plus,
who needs sleep?
Well, the thing.
You're right, Dale. It's Family Day in Canada. We'll be here.
Family Day in Canada. Raj, thank you. But the thing is there. It's a very obviously. It's a time that it's not like there isn't anything going on. This whole Russia-Ukraine situation has everybody on their toes, and who knows? There could be developments over the weekend. So, more than likely we'll be here. We'll probably be. I'll just say it. We're going to be here on Monday. Yeah, we're going to be here, whether anything's happening or not. Anyway, Gregor, let's give him some time. All right. Thanks, guys. Here, I'll stop sharing so Greg grab the chart. Hey, Gregor, how are you?
Hey, I'm fine. Thanks.
Good to see you or hear you.
Wizard.
So hey, I was going to ask you, and I'll let you to go ahead and jump in and take your charts, and I'll let you and Dale talk. But What do you make of this week's price action, buddy?
Yeah, I mean, nothing really. I mean, we are just keep moving sideways. And I'm afraid that S&P 500 will just, as you said yourself, in my opinion, still potential to retest those lows that we have seen this year. So, but eventually, on a higher degree scale, I still think that sooner or later stocks will try to catch the beat again.
All right. Well, let's see what you got. Show us some charts, and Gregor, good to hear your voice. I'm gonna let you and Dale talk.
Sure.
Okay, Blake. All right, starting with oil.
No, with the S&P. Yeah.
Okay. Yeah.
I mean, we are keep moving very slowly here, and more importantly, if we will go to the smaller time frames, you will actually see that we cannot count here 5 waves up from the recent lows from January. So, in my opinion, this still could be a wave B, maybe a little bit more complex, but the idea is that market can retest here these lows from January and then potentially turn higher. Okay, so I still think that this correction is not over yet. And even if you look at Aussie, it's still consolidating as well. So it looks like that there can be some more risk of coming. Since I mentioned Aussie, because I want to be looking for longs on Aussie, but firstly, I have to see stocks stabilizing, but for now that's still not the case. So in Aussie, I think that market is here consolidating for a wave B potential. Again, as you mentioned several times in these webinars this week, we have plenty of triangles, and I see also one unfolding here since December. So it can be a wave B looking for another final dip here to complete this complex correction from 2021.
So we shouldn't take out that high from the week, last week, 72.5 on that, Gregor? For this to be valid?
Around there, yes. That's a key resistance for this triangle to be valid, yes.
Okay.
So the idea is, if we see stocks breaking sharply to the downside, ideally with an increase in volume, and that will bring in a lot of fear. At the same time, I would like to see something similar here on Aussie as well. Maybe even something like we have seen back here in 2019. As you know, these sharp these spikes are usually very strong opposite reversal signals. So I would love to see something here, and then I would be looking for more upside on Aussie. So for now, I think still that this consolidation is just not over yet. Also, when we are looking at Aussie, I think it's very important to keep an eye on copper prices as well. What we have seen here is that copper hasn't been able to break these highs from October. So in my opinion, this triangle that I'm tracking since May of 2021 is still unfolding. It's an ABCDE pattern, and wave E here can move all the way back to the lower trend line here. So if that would be the case, then you know that Aussie again could still stay under pressure here. So that's another indication why I think that Aussie may not be ready to turn higher just yet. Also, if we look at crude oil is obviously has its own path at the moment. We all know why. But looking at here at the 4-hour chart, okay, it's still incomplete recovery. I think that there can be another retest of the highs. Notice that the structure from December lows is very strong one, but still not in 5 waves. Okay, now here we had this wave 2, which was quite deep. So I'm thinking that wave 4 could also be a little bit more complex, especially when we consider or measure time. Notice that here wave 2 this is for our chart, but anyway, we have around 48 bars. So if we respect that wave 4 is usually similar or maybe sometimes bigger compared to wave 2 based in time, then we still have a few days left before this correction could come to an end. So I'm looking at the projections for the next week, potential completion, February 23rd, 24th. That could be the day where we ideally will try to stabilize here. So I see very nice supports around $85 up to 86. So that's the area that I would focus on. Also, this $85 was this high back from October 2021. Okay, so that's the high here. So as long as we are trading above that high, I think that this is still a valid uptrend. And of course, market usually comes back to retest the highs before it may continue higher. So it may retest and then turn to the upside. If we fail here to find a support, then I think that crude oil
What's that level? 85, Gregor? 84.9?
Yes, 85, 86. That's the area that I would be looking for.
Thank you, buddy.
For the next week. At the same time, Blake mentioned that dollar CAD is trapped in a range, again, small triangle. So if crude oil will keep consolidating, if there is a room for $85, $86 per barrel, I think that this dollar CAD still has a chance to break higher. In fact, if we just focused here on this intraday structure from January lows, I can clearly count 5 waves up. While we have this current price action, very choppy overlapping, it looks like a correction from personality perspective on this price action. So I think that this can be a wave B, and that we will see a break to the upside. Of course, there can be a retest of 126 level one more time before we may finally see a break higher. But eventually, I think that there is a greater chance for a break to the upside rather than to the downside, because previously, as I said, we had these 5 waves up here. So that's for dollar CAD. Also, metals in ourselves are very interesting this week. However, still, as I warned, there is no breakout on silver yet. Okay, so I have here this overlay chart. You have in blue and red, we have gold and silver. And here in gray at the bottom, we have gold-silver ratio. So always when we see gold and silver ratio, not always, but usually moving to the downside, it usually signals that we are in a real bull run for metals, because silver in that case will try to outperform gold. But for now, that's not the case yet. Okay, it's been the case here. In 2020, we have seen a sharp drop here on this ratio. Of course, silver was doing much better, but even gold was bullish back then. But now we can see that gold in blue is moving to the upside, but silver somehow is still lagging. So what I'm waiting for is that silver is maybe will try to do the catch up here. And at the same time, I want to see gold-silver ratio breaking this channel support. If this will happen, then I would be looking potentially back to all-time highs on gold as well. But silver, again, could be...
Could we go that channel line on the gold-silver ratio one more time, the upper channel line?
Yeah, sure. It can be retested. I mean, if silver will not form a breakout, I see very strong resistance on gold around 1900 here. I would not be surprised to see some pullbacks. So yes, that's definitely possible, especially if silver will also see some pullback.
So if silver is being dragged up by gold, should gold correct, silver should underperform even more.
Yeah.
Right?
Yeah.
Okay. Thank you, Gregor.
So that's for gold here on overlay chart. Now, very simple, of course, is just to look on a higher degree charts whenever we are trapped in these consolidations, like we have been on gold for the last year and a half. I really think that it's much better maybe to make a step back, look at the chart from a distance, check the higher degree time frames, and you can clearly see that we are here consolidating. It's a very similar consolidation compared to what we have seen here back in 2018. So from an Elliott wave perspective, we have a very clear characteristics of an impulse here. Reversal, I mean, bottom here, you have a wave 1, then wave 2 consolidation, and more importantly, you have a very strong move in the middle, and usually this represents wave 3, and then you have wave 4, which is looking to try to find a base here at the previous peaks. So I'm thinking that sooner or later, yes, this fifth wave could be coming, but as I said earlier, I want to see this confirmation also from silver that we are really headed to the upside. But overall, even if this is not a real breakout just yet on gold, I still think that later this year, gold or metals in general will be higher.
Okay. So the big question is wave 4 done, and you don't think so?
Yeah, I mean, I think this Stelio showed this chart yesterday in webinar. I mean, again, it could be triangle still underway, or it could be finished. I mean, triangles are always very tricky because you think you get a breakout, but you don't get a breakout. You just see a failure move and then back reversal into the range. So I think that the key will be that we see a daily close, or even better, maybe a weekly close above 1960, which is the previous swing high. Because as long as this high holds, I can easily say that this is still a wave D rally and that we will see a wave E pullback, right?
Thank you.
So that's why I'm very careful here. We still are not above 1960, and silver is also not breaking out yet. So that's something that we have to consider.
Okay.
Okay. So actually, that's it for me. If we have any questions,
yeah,
or maybe
any questions?
If someone from the team have anything to add. You have interview today?
Yes, with Jamie McGeever. He's a Reuters columnist. So that's in about 4 minutes. I don't know where the team. You want?
Yeah, he's a super smart guy. I'm actually excited to listen to Jamie. I've been following him on social media for Twitter for like years. So super sharp guy. Yeah.
Okay. Yeah.
So it'll be cool.
All right. So anything you guys want to cover before Jamie is here? I could just go to the interview. But okay, Gregor, show your Bitcoin.
Yeah.
All right.
Yeah. Show me your Bitcoin, please.
Yeah, show me
Where is it?
10 of Bitcoins. I mean, Bitcoin is technically looks like it could be trying to stabilize here. If we just ignore the wave counts and maybe just trying to focus on these trend lines, you can see that we turned bullish here after this trend line was broken. Yeah. We turned bearish here when this rising trend line was broken. And now again, we have another breakout here. Okay, so just a very simple concept here. We held the lower range here at the upper range. So it looks like that this consolidation could continue, of course, with the room for higher prices here in the near future, if we consider that we could be bottom here at the lows based on the recent price action. But higher degree time frames still show just an ongoing correction. So is not going to be, probably not going to see, I don't know, 100,000 by the end of the year or something. I just think that we will continue to chopping around. I think that in the US, they will try to do something with regulation regarding Bitcoin and other countries as well. And this is something that should be driving the prices in both directions, in my opinion.
Are you starting to see the correlation with Bitcoin with risk off and equities?
Yeah, I mean, there has always been. And I've been warning here at the end of last year that when Bitcoin was already showing here evidences of a top of a failure break to new high here in November, Bitcoin was much lower. And of course, when stocks found the resistance, cryptocurrencies just accelerated to the downside. I think that logic here is very simple. I cannot imagine someone who takes his money out of stocks that he will keep their investments in risky assets and volatile markets like cryptocurrencies. So probably that's last place you want to be when there's a lot of fear going on.
Okay. So I want to thank you, Gregor, trying to promote Jamie. Okay.
Yeah.
So have a great weekend, Wizard.
Thank you. You too.
Cheers, Gregor.
Hey.
Cheers. Cheers. Okay.
Hey, Gregor.
Okay, guys. Welcome to F.A.C.E, Jamie.
Good morning. Thanks for having me, Dale. Can you see me okay?
Great. It's great to have you. If you want to turn your camera on, I didn't shave, but I'll do it. and we could do the talking head format like we talked about.
Camera.
It's just, you don't have a camera?
I do.
Oh, okay. All right. So everyone, Jamie writes a column for Reuters, and I thought it'd be very interesting to talk to him, have a journalistic take on what's going on. And are you able to turn your camera on?
Dale, it says that you've turned it off. You cannot start your video because the host has stopped it.
Okay, so I'm going to make you a host, co-host. Now try it.
There we go.
There we go. Nice to meet you, Jamie.
You too,
And see
Dale.
you at
Thanks for
the
having me
same
on.
time.
And before we start, can I just say thank you to Blake, and your check is in the post.
Yeah, he's a great shill, isn't he?
You're welcome, Jamie.
All right. So Jamie, I have to ask you, what came first? Interest in the financial markets or journalism?
Probably journalism, if I'm honest, but it was, if I'm being even more honest, it was probably neither. I kind of fell into journalism, and it was in financial markets that was the beat, that was the field that I started in, and that was in 1998 in Brazil, and I've been doing it ever since. So, I've got no background in finance or markets or economics. It's just been learning on the job these past 24 years.
Sounds like a lot of traders learning on the job. So was that first post in Brazil also with Reuters?
No, that was with Dow Jones. Back in the day, that was with Dow Jones Newswires, which I believe has now kind of been folded into the Journal. It's a wire service for the Journal. That was with Dow Jones. Back then, it was its own wire service, competing, very handily with Reuters and Bloomberg. So it was with Dow Jones.
Okay, so you just fell into it. You didn't dream about it in school, or it wasn't a goal of yours to be a journalist. You just fell into it. You were unemployed and you were ready to take anything?
That was pretty much it. I was in Brazil. I was teaching English because I'd graduated in Spanish and Portuguese. So I was in Brazil teaching English. And being out there back in the mid-90s, you tend to fall in with the expat community. And so many of my friends were English and American. And a couple of them worked as journalists or translators. That's how I started, actually. It was translating business news for...
And you saw firsthand on the ground some, wild economic conditions that were,
very much so. Very much so. I started in 1998.
Okay.
September, October 98 was when I started. And as you guys will know, or you guys of a certain vintage will know, around about that time, that was the Asian crisis, or the aftermath of the Asian crisis, Russia default. And then, of course, at that very time I was starting, the first week I started was LTCM. Oh,
yeah, the geniuses that couldn't lose.
Well, exactly. And I'm just, when you look back at it, I think the Fed bailout was what, $4 billion?
Yeah.
Which is, pocket change.
Yeah, that's like going out to McDonald's for them now. So Jamie has a column, and I went through your feed, Jamie, and I noticed there's a common theme with what you've been tweeting and most likely what you're writing about. And it seems to be you're a Fed watcher here. And you mentioned that I believe it was February 10th when the 10-year yield really shot up about 15 to 20 pips in a day. Mm-hmm. That was the biggest shock since Volcker. Hard for me to believe.
Yes, that was the guys at Deutsche Bank. I don't know if you get their research or have access to it, but that was Jim Reed at Deutsche Bank. And I can't remember exactly what his metric was, but it was based on volatility, daily vol relative to the average over the last 12 months. I think something like that. And that was the highest, as you say, or the biggest vol shock since Volcker, 81 or so. So, I mean, that's a measure of how interesting these times are right now.
Right. And you talk about the small amount of money that was needed to bail out long-term capital. When Volcker was able to take rates up towards 20%, the debt structure of the U.S. was completely different, and now you're writing about the Fed, and it seems to me that you have recession warnings that you're writing about, and that the Fed is tightening into weakening economic conditions. Is that your concern?
I think that's fair to say. I mean, listen, we all know what the yield curve or the 2s, 10s or any part of the yield curve, we all know what they indicate or what they don't indicate. You can have your view on that. But I mean, it is an incontrovertible fact that the 2s, 10s inversion has preceded, I think, every single one of the last 6 recessions. So going back to the early 80s, late 70s. Before that, slightly different story, but certainly the last 6 US recessions have been preceded by an inversion of the curve, whether that's a month or 2 before, a couple of years before. So again, is that causation or is that correlation? Everyone has their own view on that. And another sort of red flag that I've been looking at, and this is one that's been promoted or flagged very much by Professor David Blanchflower, who's a former Bank of England rate setter.
I've interviewed Danny.
You know Danny well, yeah. Now he's quite a character, and not everybody agrees with his views. But he's a labour market economist, and he did a research paper towards the end of last year with a colleague whose name escapes me. But they were looking at consumer sentiment, the UMISH sentiment, and other gauges of consumer sentiment.
Happiness. He measures happiness.
Well, define happiness.
But his $1 more than you need every month.
Well, yeah.
And misery is $1 less than you need every month.
If only it were that simple. But his paper found that consumer sentiment, big falls in US consumer sentiment are key red flags and alarm bells that we should really pay attention to. And they always precede recession. And we've all seen the UMISH consumer sentiment numbers lately, the lowest in 10 or 11 years. The magnitude of month-to-month falls is pretty chunky. So you put that together with the yield curve inversion warnings or flattening curves, etc. You do get a sense that something may be coming on the horizon. Maybe not this year, but next year. And also, just one more point on that. I think if you look at certain parts of the forward parts of the money market curves, Fed fund futures, you find that rate cuts are being priced into late 23, early 24.
Yeah, and who knows? They could come sooner.
It could come sooner, but right now we're looking at 23, 24. It may not be pretty for the economy, and all that depends as well how far the Fed goes. It may take a step back, take its foot off the gas, and think twice about 7 hikes this year, for example.
What's your guess for the first one, 25 or 50?
Well, maybe the head says
try and make a statement by going with 50 and maybe even some balance sheet drawdown.
Maybe the head says 25. But if you look at the Fed commentary in the last week or so, since 50 has been virtually fully priced in.
Bullard.
Well, does he speak for the committee or not? Probably not. Yeah. But even the others on the committee who've given press interviews lately, none of them have really pushed back firmly against the idea for 50. So you have to assume that to some extent they're happy with the current market pricing. So maybe it's 50.
I suspect, and I know that Greenspan used to, the Fed does follow the price of gold. And the signal gold's giving right now is they probably need to do a little bit more than a little less, unless it's just, safe haven flows because of geo matters. You made a very interesting comment. We tend to look at things simplistic. Well, the Fed made a mistake. They were loose too long. And all they're going to do is just even out the playing field and too tight, and it doesn't make it even. You say that it's additive, okay, rather than balancing. So can you just talk about how, just because they're going back to what's normalcy, it still can cause problems?
I think that was actually, I can't claim credit for that quote. That was from the guys at Citi, I think.
Oh, okay. You must have retweeted it then.
I did. And,
okay.
I hope I didn't pass it off as mine. But it's a good point. And I think essentially what they're saying is 2 wrongs don't make a right.
Yeah.
I mean, just because you've swung, maybe because you've been too accommodative in the past, listen, we can't turn back the clock. There's no going back to, you can't change that. But what you should avoid is going too far in the opposite direction to try and balance it out, because that's not how it works. Too long don't make it right. So they have to manage the situation as they see it, not as they maybe would like it to be in an ideal world.
Do you think that the Fed cares about the dollar, and could they use it as a tool by weakening the dollar? I know the rest of the world would like to see that, but isn't that a way to kind of soften the blow of tightening by weakening the dollar?
What was it somebody once said, our currency, your problem?
Yeah.
Yeah. Well, is our, I mean, I'm speaking from the US here, is our currency, right. And I don't think the dollar's a problem right now. I don't think that is first and foremost on the Fed's radar right now. However, of course, that can change if there was to be anything resembling a run on the dollar, or it was to show signs of strengthening sharply on the back of these, hike expectations. Yeah. Obviously, a strong dollar does, tightens financial conditions. I think the Fed's very cognizant of financial conditions, and I think where the dollar to contribute to an unwarranted or unwanted tightening in financial conditions, that's when it would come on the Fed's radar. But here we are, 113, 114 on the euro. It's not going anywhere fast. It doesn't seem to be going anywhere direct. I don't think the Fed would use it specifically or directly as a tool. However, I think they would prefer it to be on the weak side than on the strong side, bearing in mind its contribution to financial conditions.
Okay, you talk about, I wanted to, maybe you could clarify it for me, that a lot of analysts were looking for 2 to 210 on the 10-year, when it was 130, they made some good calls, short bonds, etc. And they're actually, some of these same people that called this rise in yields are actually looking for yields to peak, that they're peaking in here, and that they could begin to fall even back to, 1%. So has the market already done what the Fed's going to do as far as yields are concerned? We're at 195 now. If the Fed goes a quarter, is that may not cause higher yields because we're already there?
Well, you've been doing
it's a conundrum for me.
It is not, but listen, you know exactly how these things work. If the market gets a whiff of blood in its nostrils, it will run, and it's certainly moved in the last 6 weeks. In my experience, this shift in market expectations and pricing, and the following shift in analyst expectations has been. I can't recall anything so sudden and so quick and so extreme in such a short space of time. So the market has, as always, run ahead of itself.
Okay,
I think that's fair to say.
Those bond vigilantes.
Sorry?
Those bond vigilantes that were around in the 80s.
Well, they certainly, they moved in the last 6 weeks. We got up to 210? Yeah. So I think we're in for a period of cooling off. As you mentioned earlier, we've got geopolitics on our radar as well. That situation is bound to put a bit of a bid under bonds. I think we saw today the Bank of America weekly fund manager flow data, 7.4 billion inflows into treasury funds last week. That's the highest in 2 years.
Okay.
So when you get to 2% on the 10-year, you've got things bubbling away in the background, fears of policy error, geopolitics, Russia, Ukraine. There are going to be buyers of bonds out there, and potentially big buyers of bonds. So do we run up to 250? Not so quickly, perhaps. Although I was interested to see only yesterday the bond strategist at Credit Suisse, whose name escapes me, but the chief US guy, he revised up his treasury call, his 10-year call, to 270 for this year.
Wow.
So 270, given where we've come from in such a short space of time, that seems to be on the extreme side. However, 3 or 4 weeks ago, I thought 7 Fed hikes was extreme from Bank of America. Now that's almost consensus.
Okay, so we know what people are buying. I also saw a tweet where you talk about that acronyms do not last, like FANG, MAGA. I'm trying to think of an acronym that people used to use that's not around anymore. Do you have a couple?
Well, there was one that I didn't mention in the piece, but one that, as you'll remember from the Eurozone debt crisis, at the peak or the depths, if you like, of the crisis, was PIGS.
Oh, that's
remember
right.
the PIGS?
That's right. Yeah.
Portugal, Ireland, Italy, Greece, and Spain. Basically the Southern European Eurozone bonds plus Ireland. All of these countries to varying degrees were in big trouble with their debt and bond spreads, and so the acronym was PIGS. Of course, Ireland got a bailout first, and then they were taken out, but it was still PIGS because there were two I's. And for the obvious reasons, there were no PIGS funds opened up or anything like that. It was rather more insensitive than FANGs.
The ECB just put lipstick on the pigs.
Well, there you go.
Right, and it worked. Worked for quite some time. Could it unravel again?
It's hard to say. I mean, if they survived 2012, then they can probably survive most things, I would think.
Okay.
I mean, don't forget how bad it was back then. I mean,
I
think the spreads on Spanish debt were 700 basis points, 7%, and it was when Draghi got up to speak that day in July in London. Things were teetering on the edge.
They were, and we're not teetering. And you thought that 15 minutes was going to be a long time, and we've gone for 25.
Well, 25. Well, time flies.
No, we've gone 16.
16.
16.
Well, happiness is 1 minute more than you were expecting.
We're on schedule, and Jamie, it's really you should do more of these. You're excellent. You have a great demeanor, and I learned a few things from you today, and I'm so glad I reached out and was able to convince you to come on and try it, and hope to have you back.
Well, that's very kind of you to say, and it's been an absolute pleasure. And listen, if you have me back, then I'm happy to come back.
All right, Jamie. And I don't know if you trade or not. You probably have rules. The Fed can trade, right?
The Fed
can, but not journalists, right? I mean, you'd be in jail if you did what some of the Fed governors did, don't you think?
I can't possibly comment.
Anyway, all right. So, Jamie, thank you so much. You're really great. Blake's a fan, and appreciate you coming after a long week to talk to us today, Jamie.
Thank you, Dale, and hopefully I'll speak to you again soon. Have a nice long weekend.
It's a deal. All right. Adios.
All
Jamie could follow Jamie McGeever at Reuters Jamie. Follow him there, or go to Reuters and read his columns. Thank you, Jamie. All right, everyone. Have a great weekend, and we'll see you on Monday. Even though it's President's Day, we're not celebrating our presidents here at ForexAnalytix. Monday, we're going to be working with what's happening geo-wise, and you could join the team in about 20 minutes on the Morning Edge. Thanks again, Jamie. Have a great weekend.
You too. Bye-bye.
See you, everybody.